Okay, we're going to start the investor panel. One of the speakers that's on the list couldn't make it today, but we have a great panel here. So with quite a range of angles and investment experience and operational experience. So we'll start with a quick round of introduction. I'll start last. Sita, do you want to introduce yourself?
Sure. Sita Santi, partner and associate director with Boston Consulting Group. I'm based out of our Washington, D.C. office, representing the Aerospace and Defense Division and running the commercial space topic for the firm globally. And right before my time at BCG, I was head of human spaceflight at SpaceX.
Hi, Raphael Rodkin, managing partner of E2MC Ventures, which is an early stage, purely space-focused venture capital firm based out of Zurich. My firm is based out of the US, my partner's in the US, and we invest across the global commercial space ecosystem.
Hey, good morning. My name is Richard Kivel. I'm with Graybella Capital, which is a pan-European venture fund. I'm based primarily out of London, originally from Boston. We invest broadly in technology, so everything from robotics to fintech and space tech. And I have the privilege, I guess it's my third year being at this conference. It's great to be back.
Hi everyone, my name is Quentin. I'm an independent consultant and I help startups with financing matters. So recently I've helped Earth observation company to raise the Series B. And prior to that I was working in private equity, mid-market buyout firm, and I'm based out of London.
Okay, and I'm Thomas Ferre. I work for the European Investment Bank. The European Investment Bank is quite involved in the group itself is quite involved in space in a number of aspects. We've got the lending program that lends to companies like Eutelsat and Ariane, big loans. We've got the EIF, a sister company that has a big fund-of-fund program. It invested in funds like Primospace, Orbital, Luxembourg Future Fund. We've got the venture debt division that invests in companies that are looking for tickets in venture debt, typically at a Series B stage and later, between 5 and 50 million euros. Some of its investments include Spire, the Orbit, and Eurosat companies across Europe, of course. Keros was a recent investment. And then I work actually specifically within the EIC fund team. The EIC fund team does venture capitals under 15 million euros in investments, in co-investments. One of our recent investment was Hyber. We've got some companies here that we're also looking at. Nemesis, they're going to present later this afternoon. I'd like you to pay attention to them. So, but here we're going to talk about investing in space. There was a moment in history where the biggest investor in the private market in space was film producers. This has changed. The number of satellites, private satellites in orbit has greatly increased. Let's talk about the main sectors of focus for investors. And a sub-question to that is, if you want to address it, is the opportunity for climate tech. Sita, do you want to start?
Sure, happy to. One thing that we're discovering, if you look at the last 12 quarters of SPAC activity in the United States alone, we've seen the greatest amount of redemption rates overall in all SPAC activity, not just space, being quite high. However, what's interesting about the space economy is that the overall redemption rates, the median redemption rate, tends to hover closer to 22% over the last 12 quarters. By contrast, the average redemption rate is closer to 41% across all SPAC activity. What does that mean? Essentially, it means that investors who are utilizing the SPAC as a tool to invest in the space economy in the United States have a longer threshold or a longer time horizon for their expectation for the return on investment. What do they expect to be having generated returns for their investment? And that's largely two aspects of the space value chain. One of them is SATCOM, satellite-based communication, really focused on lower Earth orbit. The other is Earth observation. So SATCOM and Earth observation are generating what we would say, particularly in the last 12 quarters of SPAC activity, the greatest expectation for return on investment, the lowest rates of redemption, utilizing the SPAC as a tool. And finally, the expectation that those rates of investment are going to deliver returns based on value-added services. So what do we mean by that? The expectation that SATCOM providers will continue to grow because they're going to be offering services as a subscription model like Netflix. And same thing with Earth observation. You'll not only be able to collect imagery from a particular plot of land, but you'll be able to collect analytics as a service in a subscription model. So because there are these trends that are occurring in SATCOM and Earth observation, I think investors are paying both very close attention to those segments of the space value chain, and you're seeing real quantitative evidence of that right now just with the SPAC market in the United States alone.
Yeah, and so I pretty much agree with all of the things that Sita said there. So let me maybe add something different or frame it differently. One way that we at E2MC are currently framing the space economy is sort of infrastructure versus applications. And I can make the comparison here to the days of the internet. I'm old enough to remember that, sort of the late 90s, early 2000s, when in the beginning there was a lot of excitement and built out and a lot of capital investment in the infrastructure, right? Global fiber networks, a lot of companies that are now bankrupt, like WorldCom and Global Crossing and so forth. Companies that put in the routers, like Cisco and so forth. But then the really exciting phase started, the companies that deployed applications on top of that internet, right? Which of course we all know, companies like Facebook and Airbnb and so forth. And because we are early stage investors, and a lot of the infrastructure stuff is now too far along in capital formation, we're getting really excited now thinking about what kind of applications can we deploy on all of that new space infrastructure that's up there.
If I may add an element on climate, I think, Thomas, you mentioned that. So what I notice is that many investors who were not looking at the space sector nowadays look at what satellites can provide in terms of services to tackle climate change. So you have, for instance, Contrarian Ventures that invested in Satellite View, and I think that's very much for the services that they can provide to tackle climate change. I think that's a huge trend. For instance, when it comes, there are lots of frameworks, impact frameworks. I'm thinking about the Sustainable Development Goals or the Impact Management Project. All of these require lots of metrics, and these have to be measured objectively. And I think that satellite data can provide the objective measures to look at what's the performance in terms of impact or ESG for many of these investments that are being made. So I think that the space industry has a lot to offer when it comes to tackling climate change.
Yeah, I would have to second that. When we take a look at specific companies in the sector, the areas that are of greatest interest to us are where we see a hardware and software combination. That seems to be for us the real home run, because you ultimately have the power to control the way images are taken, and then ultimately the way data is being captured is just one example. So we're seeing a lot of growth in the area and a lot of trends towards the area of massive data sets being collected, whether that be for agricultural reasons, in order to actually, groups like Archer Daniels, Minlid, Monsanto, some of the largest farming organizations in the world, using satellite data in order to try to capture drought, obviously infestation, also various trends within the particular ecosystems they're tracking. Governmental use in fisheries, all of these things are very much tied to environment. So as you can start to track that data, you can start to then be able to speculate, look at second and third order consequences of particular climate events, and then the companies are able to make much better decisions down the road. So when we think about technology, it's nice to have a hardware-software combination. And when it comes to the actual, I guess you could say, implementation of these technologies, very often it's on the back of existing technology. So we're looking at one company right now as an example that is, managing constellations of satellites and being able to position them in very specific orbits. That's the type of thing that's very exciting, because they didn't have to invest in all of that infrastructure, but there's a hardware-software component of this. It gives some serious barriers to entry and intellectual property.
And it's really interesting. Some of the things that I heard here, I heard about SPAC, and we have a question on this later, so I'll put that to the side. I've heard about the concept of space as an infrastructure play versus the app around it. I've heard about hardware and software. I think I fully agree with all those statements. The concept of infrastructure means that basically all technologies are going to be needed for space. And so if I look at EIB, the things that the venture debt team is looking at, if I look at the EAC, what we're looking at on the equity side, it's everything. It's Earth observation, it's IoT, it's telecommunications, it's resource utilization, it's manufacturing, it's services, it's just everything across the board. I'll just make a comment that when I was analyzing a year and a half ago the 500 or 600 unicorns around the world, there was not a single unicorn that was just purely hardware. So obviously the software is a very important element of a startup's, I would say, growth prospects. I'll just mention that as a side note. Finally, I'll mention Quentin, you were talking about climate. Unseen Lab that's over there raised recently, I think about maybe a year ago, a round with Swen Capital, maybe BPI France was part of it, and they are focused on image observation, specifically as it relates to pollution of the oceans. Now that reminded me about 60 years ago, well, actually, 3 years ago, I was having a conversation with a great uncle of mine who was in his mid-90s, who used to be a fighter pilot in the 40s and 50s. It doesn't bring us any closer to space today, but he was telling me that in the 60s or 70s, I can't remember the date, he was one of the first one to integrate. So he was doing surveillance on some of his planes during the wars of the 40s, 50s, 60s. And he was telling me about how he managed to sort of create a very big innovation for planes to integrate very accurate photo systems to be able to track pollution of boats on the oceans. And this was 60 years ago. And so, obviously, the fact that this is being pushed to space with multi-spectrum imagery and a whole number of new technologies that you're able to scan a number of times a day, etc., I think that's a big, important progress, and that certainly has a lot of legs. I want to move to another topic here. Sita, we're excited because you have this experience of SpaceX, quite unique on this panel. Let's talk about EU versus US. Yesterday there was a great panel from ESA that talking about the ability to scale and how do you do that versus Europe versus the US, and I'd like to rebound on that. Do you want to say a couple of words about how you look at those markets differently and how perhaps, coming from an experience at SpaceX, you might, bring some insight into what Europe needs, going forward?
Absolutely. I think another way to frame the question is, what are some of the key incentives required for startups and new participants in the space economy, whether it's in the United States or in Europe, to be successful with a transition towards the commercialization of space, right? I mean, that was the frame for the conversation yesterday, which I thought was really insightful. There are a couple of key lessons that you could learn from the United States experience. Number one, there's a perception, particularly in the case of SpaceX, that this was an overnight miracle. The amount of success that has been achieved through a variety of solutions, whether you're talking about Starlink, human spaceflight, obviously the launch vehicle, reusability, etc. These are not overnight successes. These required tremendous amounts of both capital investment, but they also required significant US government investment. So I would say point number one, for successful commercialization of a space ecosystem that allows for new entrants to really successfully come online, there does need to be a critical role played by both the government agencies as anchor customers of the eventual service or product or capability, but also of the government to identify various subsequent acquisition vehicles. So again, I'll restate that. If in a perfect world, one of the key lessons that could be applied from the United States context is various US government agencies are anchor customers who are going to say, we want these capabilities 5-10 years down the line. But then to be able to pivot 5 to 10 years down the line to have agile contract acquisition vehicles to continue to adapt, because 5-10 years down the line, the technical capability will be different than what was previewed, right? So I think those are a couple of key lessons learned, and I'll offer one example. The Commercial LEO Destinations Project, or CLD, this is a major contract vehicle that NASA has recently issued, and as a consequence of which, we will see what the next generation of the ISS is going to look like. And that next generation of the ISS is going to be commercial in nature. It's actually super exciting. And the winners of CLD, one of the big winners is a project called Orbital Reef, which is a joint venture led by Blue Origin, with other partners such as Sierra Space and Boeing attendant to it. Why I think that's interesting for this crowd, particularly as you're looking at investment, the right kind of commercialization ecosystem allows for existing government projects to have complete evolution over time and let the commercial bidders design it themselves ultimately. So there needs to be flexibility in the design. And finally, I think as those commercial entities come online, they need to be open to the likes of startups to be able to say, we want to be your supplier. Let's identify now what those supplier relationships are going to look like that enables the startups to achieve their economies of scale and growth as well.
Yeah, once more fully agreed with Sita. So I guess I'm in an interesting position here because I am a European who has a US fund, so this topic is close to my heart. You know, until very recently, and frankly still today, I would have said one way Europe should play this is that Europe should play its strengths. And what are Europe's strengths? For example, those are that we have some of the world-leading companies here in sectors like automotive or insurance, and there's an opportunity to bring those leaders together with space, which by and large hasn't happened yet, right? So that was my line until about 2 or 3 weeks ago, and I still believe that. And then I always used to say one reason Europe has to do that is because we will never be able to match the money that's coming in the US from the military and from the intelligence community. Well, the world changed a lot in the last 2 or 3 weeks. See just the Germany announcement, how much the military budget is going to increase. So now suddenly we may have something here as well, that there's going to be additional money in Europe for space coming from those sources.
Really agree with that. I think what we're seeing around the key incentives that you pointed out for really startups to commercialize is that public-private sector partnerships. We talked a little bit about ISS, and in fact, when I was first introduced to this industry probably 10 years ago or 8 years ago as it was really growing, it was through people like Cynthia Buteau and others that were working for NASA in their group called CASIS that was specifically focused around commercialization of the International Space Station. So they were working with pharmaceutical companies, telecommunication companies, and others to fly experiments into the space station and do really new fascinating work, looking at things like protein cell crystallization in a low gravity environment, looking at highly radioactive environments and the impact on materials or electronics. And I think we'll see more and more of that as the next generation of ISS comes out. And that's where obviously this, public-private sector partnerships work so well, because no one in the private sector can afford to put up an ISS, but we can all leverage the ISS and its capabilities and next generation ISS in order to enhance our products, technologies, and services in order to become much more effective in whichever sector that we're in, whether it be propulsion, new materials, robotics, storage. So that's one side of it that I think is really important. The other piece of it, Europe, US sort of incentives. Our fund invests in Europe, so we're a European fund. What we see here that is really quite interesting is that many of the various countries, whether you take a look at Luxembourg, you take a look at Italy, they are really trying to choose very select areas. They're not trying to do everything. The US approach is we do everything, which is we'll just raise gobs of money, and every state that wants to play in the space game can do that. Doesn't matter whether you're Florida, Texas, Massachusetts, California, and there's a lot of redundancy. Whereas what I see is a much more intelligent approach in Europe where they're all not trying to do everything. Whether it's playing to their strengths or they just pick a fight that they want to win, that's very powerful. But that takes a high level of creativity to manage if you're a startup. Because one of your partners might be ESA, and then another partner might be the Italian Space Agency, and another partner for a different part of your project might be in Luxembourg. And that's different than the US, where you could pretty much deal with DARPA or NASA to get all of your governmental work done. So I think innovation and change is really required for startups to succeed in Europe, because it's not a one-size-fits-all, one location, one phone call. Different grant programs, different investors. But I think the opportunity here is absolutely tremendous, and we're going to see it growing, not just because of military spending, but because of a lot of other areas where we're going to be able to leverage what's happening right now in this sector.
Thank you. If I may, just lots of the good things have been said, so I don't have much to add, but from my experience, what I've noticed in Europe is that the importance for young startups to rely on grants, government funding is quite high, and I have the impression that in the US, VC funds are happy to invest faster, take more risks, versus Europe. The need for government funding is probably less in the US than in Europe, and that translates into perhaps slower growth in Europe for some startups versus in the US. That's my impression.
I think just a comment on that is part of the problem in the US is that there's just too much capital. So you've seen these funds that have just grown exponentially, where people are raising Fund 2 at 700 million, Fund 3 at 1.1 billion, just these crazy numbers. But what hasn't changed is the timelines for venture capital. Your typical venture fund is a 10-year fund. It has a 3 to 4 year, maybe 5, but probably 4 investment period. So what you have there is some really hard math, right? You take an $800 million fund, you've got to figure out how to deploy $200 million a year for that 4-year investment period. And that's a problem. So you can either invest in a whole bunch of deals, many of which are mediocre, or you invest in less deals and you put really big tickets into those companies. So your Series A is now 70 million, whereas maybe on Fund 1, your Series A investments were in the 15, 20 million, 30 million range. But now you've got to deploy 200 million this year. And there's only so many deals, and you've got a lot of other big funds that are chasing the same deals that you're going after. So you see this sort of artificial inflation of valuations and just a massive amount of capital going into companies that in many cases don't deserve it. In Europe, I have not seen that, and it's one of the other big advantages of being here is that people are much more efficient around the use of cash. Salaries are more reasonable, the cost of legal, accounting, real estate, everything. And then you have the advantage of arbitrage. You can take your company here, very reasonable valuations, and then ultimately it may get acquired by a US player or go public there at a valuation that is significantly higher than the equivalent company sitting in New York that's already overinflated.
Richard, do you think that is an explanation behind why there was such a growth in SPACs in space? Essentially, there's too much capital to deploy in the United States, looking for more vehicles that would allow for the amalgamation of that capital into larger groups as opposed to the traditional VC model. And then a second thought that occurred to me, which is, this is something that I've actually been advocating with my government clients. What if government acquisition took a page out of the SPAC playbook, where you have a higher risk tolerance, you have a higher failure tolerance from a tech side, but you have a shorter turnaround time for expectation for delivery. So these are a couple of ideas that I've thought of really just to be a bit disruptive to government clients as they think about acquisition and serving as those anchor customers, but also would love to hear your thoughts on, is that why SPACs became such a thing?
Yeah, I think not just obviously in the space sector, but almost in every sector. I mean, SPACs have been around for 20 or 30 years. They're nothing new. They just go in and out of favor. I mean, you can look back at, literally Bear Stearns was doing SPACs in the 80s and 90s. So SPACs, just being these special purpose acquisition corps, are just a mechanism where you as an investor can deploy capital by investing in a management team that's going to find something to buy. And then your capital becomes liquid because it becomes a public company. I did one of these in December, a company in the US that we took public, not in this particular sector, but in the technology sector. And it's a much faster way of going public. It's generally a very clean way of bringing a company into the public markets, which gives you access to more equity, debt financing, and other creative things. But going to your point earlier, the redemption issue is a real problem. And the redemptions, for those that aren't familiar with it, essentially you'll hear about these people that raise a SPAC of 600 million. What they actually have is commitments from investors. So let's say they have 6 investors that are all committing 100 million. And they're saying, our thesis is we're going to go buy a company in this particular sector, the space sector, or the healthcare sector, or the fintech sector. As an investor, I have a right to basically pull my capital if I don't like the deal you're doing. And one of the reasons I believe that redemptions are less in space is because nobody builds a space SPAC and doesn't buy a space-related company. But you would not believe how many companies are out there that are intending to do a consumer play, and they're going to do a B2B blah, 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 and they go from looking at fintech to apps to health clubs and then boom, they finally find a company to buy, and the investors say, whoa, 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 that is not what I bargained for. I'll take my money back. So you see these huge redemptions in industries that allow for more flexibility, whereas the space sector or the healthcare sector, it's incredibly focused, right? Whereas tech is just so squishy.
We sort of organically moved to the, I would say, one of the final points of this panel, which is about SPAC. I just want to go back to EU versus US and then make another transition to the SPAC topic, because I think it's a very important one. I heard, listening to all of you, some interesting points. One of them, the starting point, many good points, Sita, today. I'm glad we're starting with you. We get like all the good, the good insights, and then we just have to fill in. No overnight miracle for SpaceX. Key government as anchor customer. That's a very important topic, which is always amazes me how Elon Musk is not necessarily government friendly when he speaks out, and yet every single one of his major companies, Tesla and SpaceX, only survived because of government funding, which is, anyways, that's for another point. Just a show of hands, I'd like to just survey the panel here. Planet Labs is one of the companies that basically launched, I would say, or popularized the LEO smallsat movement, and did a SPAC late last year or mid last year. I'd like to just do a quick survey. How many of you think that Planet Labs, that's been around for, let's say, 10 years, has more than $1 billion in revenues? Okay. How many of you think that Planet Labs has less than 100 million in revenues? Okay, well, so they have about $113 million in revenue. That's what their declared revenue for, I think, 2020 was. And their valuation at the time of the SPAC was, I think, 4 billion. The value of the market cap was 2 billion, and right now it's at 1.2. I just checked this morning. So, what does it tell us about the SPAC route? Now that we've been sort of saying, well, it's a very interesting route. It offers access to capital, to funding from various aspects. Do you want to talk a little bit more?
Absolutely. I deliberately did not answer the question about Planet because they're a very, very close friend and client. But what I can say about Planet Labs, which is very interesting, is as follows. I do think, and I appreciate, Richard, your perspective on SPACs sort of coming in and out of favor as a vehicle for amalgamating capital, the capital does need to be quickly deployed. That's, I think, the emphasis. And so for a company like Planet to be truly successful, there needs to be quick deployment of their capital. And I think we will actually see evidence of that in the next quarter for sure. I do want to revert back to the importance of the use cases for the companies that are leveraging the SPAC, right? If you have tons of capital and if you have a vision, a business model that allows for you to quickly deploy it, what are your use cases? Where are you actually going to be able to generate not revenue, but faster revenue? Because that's what's expected. And I come back to SATCOM and Earth observation. Planet Labs is a perfect example. They're pivoting towards not just big, fat bunches, terabytes of data in pictures, but towards a subscription model. So, and not just moving from like Blockbuster where you rent the video to Netflix where you have a monthly subscription, but the newer version of the Netflix subscription model, which is much more data to choose from and for a more competitive price point, so price bundling. There is an employment of newer, what I would describe as financing methodology and pricing methodology and go-to-market methodology by the smartest of space companies who have SPAC capital on their hands. And the ones who are successful are delivering use cases for Earth observation to whom? Who are they selling their subscriptions to? They're selling them to agriculture companies, like you were mentioning before, Richard. John Deere, in fact, I can publicly say is a significant client, a big end use case for leveraging Earth observation. They're also selling to mining companies. If you want to effectively mine shale, you need to have good imagery, not only that tells you steady state what your plot of land looks like, but that can predict 6 months out what it might look like. I think identifying what those use cases are early, selling and developing revenue streams with those newer use cases is going to actually generate the quicker revenue to leverage the SPAC capital that is coming in. And the winners are going to be the ones who have already identified those use cases, who've already sold subscriptions effectively to those multinational companies, and who are going to make announcements about it, in the next 6 to 9 months. So watch this space.
Yeah, so I agree with Sita. Let me frame this a little bit wider. Like, SPACs are no magic bullet. They were a magic bullet for maybe 1 to 3 months last year when redemptions rates were low and the pipe availability was really good. And arguably, maybe companies like Rocket Lab or Spire could raise more money more rapidly than it could have raised in the private market. But it's over for now. The pipe market is dried up, the redemption rates are high. So now, if you merge with a SPAC that has $300 million cash in trust, maybe you can count on getting, 30, 50 million. Maybe you can get another 20 from the pipe. So you're somewhere in the order of size that you can absolutely get in the private markets. And then you should make the analysis as usual. It's not only about capital, it's also about other value add. Like, does the capital come with other people who are qualified, who can help you otherwise? And honestly, for most SPAC deals, this may sound arrogant, but I don't think that has been the case. They were just capital shells, right? The only pockets of exceptions we have in the SPAC market is, for example, biotech, where we have some really deeply qualified people who are just doing biotech and then they merge with a biotech company. But apart from that, it's been ridiculous examples, like cannabis companies merging with a space company and so forth. And that, I think, justifiably doesn't have a future. I do think SPACs may have some advantages, but it has to be, I think, going forward, really specialist SPACs that can add much more than just capital.
Perhaps one more comment on SPAC. Once a company has gone IPO, a private company has gone public through a SPAC, it's much more difficult for it to raise capital thereafter. So you have to be very careful when you want to go public. If you don't meet your targets business plan, it's going to be much more difficult to raise capital thereafter. So one way to look at it is when you raise a SPAC, you should make sure that after that you're on a path to be profitable or no longer having huge investments to make the business plan work.
I guess a few other points. I won't talk really about SPACs anymore, but I will say that is a great point around your inability to actually raise fresh capital if your SPAC you're essentially, it's called de-SPACing. So essentially, once you de-SPAC the company, it's now a public entity. And if you're not running the business like a public company and getting a lot of analyst coverage, you're not going to continually be able to raise more capital. So that's certainly something that the venture industry won't touch. The same, I will say, goes for small public markets. This morning, I had breakfast with a French venture fund called Jolt, and we were talking about what's happening in some of the smaller markets, such as Nasdaq Omex, which is out of Stockholm, or some of the smaller markets. The challenge is that they're easy to go public on, but the problem is that once you're public, now all of a sudden you have all this pools of capital and venture capital that we're actually not going to go buy your public stock. So my advice a lot to entrepreneurs, and I come from the background of running companies, not investing in companies, is the best way to raise capital is initially non-dilutive capital. Get as many grants as you possibly can. Talk to strategic partners. If you know you're going to be selling to Lockheed Martin, Boeing, whoever, Airbus, talk to them. Try to get strategic money into that company. And then the next sort of level is bringing in institutional money, or even maybe before that, friends and family. But if you really need to raise significant capital, the venture market has plenty of it. And you don't have to deal with the headaches of being a publicly traded company for the most part.
So I just want to add on to Quentin's point. Just to really emphasize, once you're public, you are under scrutiny, right, because of quarterly reporting. And so there's what's been going on with the SPACs, right? The SPACs have this unfortunate incentive to really because they're allowed to give forecasts, right? They have a so-called safe harbor in the US. So if they can actually give forecasts, and they're incentivized to give very aggressive forecasts so their SPAC merger gets approved. There's academic research out there that less than 30% of the companies afterwards hit those targets. And that, of course, is not great.
One comment I'll make, if you want to read a great article on SPACs, Sita wrote an article in Space Week, the December issue, and it is outstanding. It gives you like a really deep insight into how do SPACs work, why do they work, which ones have worked. December issue of Space Week, highly recommend it.
We don't have a lot of time left. I want to make sure that if there's any questions coming from the audience, technically we have another 5 minutes, but if there's any question that you want to ask, raise your hand. We spoke quite fast, I would say, and we went quite diligently through all of the topics. One question over there.
I'll ask a quick question. So you kind of talked about this throughout the panel, but what do you think the next 2-3 topics will be that most investment will go into in the next couple of years, considering the effect, the events of the last couple of weeks?
Who wants to take this one? I can't answer because we're looking at the entire landscape of technologies. So I can tell you that we're looking at all the. That's my answer. Do you want to?
I think everyone is looking at everything. Two aspects of the value chain that are interesting to me: space situational awareness, the geometrical tracking of objects in space, is going to have multiple applications, or it already has multiple applications, both for commercial space entities that are putting more payload in space and want to de-risk the likelihood of a space collision or an event, but also for military purposes and national security purposes. So there are new providers of SSA, or space situational awareness. A company like Leo Labs is a great example, who are detecting and tracking what's happening and able to make predictive statements about where objects will be. I think that's actually going to derive a lot of growth. There's one other, which is in-space manufacturing. I fully anticipate that as you see the potential for edge computing and cloud computing to occur, not only utilizing ground infrastructure and servers on land, but also utilizing particularly the small sats being manufactured by Starlink in LEO. There's going to be a move towards cloud computing from space as a new platform, and I think there's also going to be an interest in driving investment in that direction.
I'll just mention that you were talking about Share My Space is one of the companies here that does exactly what you were talking about, trying to figure out. I mean, Steve Wozniak made an announcement just recently, so I think that certainly is a very important topic. Anybody wants to react as well on some of the? Yeah, no, okay. Okay, last point. What's your recommendation for the CEO of a space startup? What should they focus on right now? You've got 1 minute each.
You start this one.
All right, so this depends. But what I still see in the space sector is that almost 100% of the business plans that we get, the founders are basically from the space sector and they're technical people. And I have a lot of confidence in they're going to get the technology right, but they typically haven't done enough market analysis. So typically I want them to focus on, okay, who are your customers? Why are they buying your product? That's really by far the most important. Of course, there are exceptions to that. We invested in a fusion propulsion company. There it's all about get the tech to work, don't worry about the customer. But the typical case is find your markets, define your customer.
Totally agree. What is your TAM, total addressable market? Who are your known customers? Who are your unknown customers? What are the use cases for your technology that you have not thought of? And who is selling your product? If you don't have a good salesperson that can translate your technology to somebody outside the space sector, then don't even bother.
Go ahead.
Thank you. I totally echo that. I think the commercial angle for CEOs is very important, and I could add the comparative advantage of your company. I think oftentimes it's they see it's a great product, a great idea, but they fail to realize how they're different from the competition. And I think that's critical for investors to understand how they fit with respect to the competitive landscape. That's one element, the commercial angle. And the second element I think CEOs should also focus on is more related to the governance within these companies, the teams, making sure that the right governance bodies are in place. I think that provides a lot of comfort for investors to see that the right setup is present when for the growth of the company.
Yeah, I would just add, engineers like to have things done perfectly, so no product is really ever done. And one of the great skills of a good CEO, I think Steve Jobs did this, Microsoft certainly did this under Bill Gates, is get a product out there as quick as possible for minor levels of validation. Get Northrop to play with it, get somebody big to play with it. They're going to give you feedback, help you iterate, and ultimately create a truly commercial product. But don't keep working in your lab hoping you're going to create the perfect commercial product. That's certainly one key thing for CEOs. The other one is just raising capital. You have to have a CEO that can actually effectively communicate the story to very diverse audience, whether it be government, grants, public-private sector investors. But raising capital, it's pretty much a full-time job.
I'm not going to be so different, but if I can certainly expand on this. We talked about a team, a lot of great engineers work in the space industry. We've talked about customer acquisition. We've talked about capital raising. I think my point will be customer success, which is bring a great product to the market, but also make sure that it integrates well within your client's environment. So some of the companies that I've seen, and it's particularly true in the space sector, is they might have a great product, but they don't really work well with the client's engineers, or they don't think about all the aspects of the integration of their product. And customer success is a very big part of your path to success. So with that, I'll conclude the panel, and thank you so much.